Morning. Give folks an opportunity to join. A lot to talk about today. I got to tell you something. Yesterday, I was going through these calendars, Yahoo, as I've shown you, and then MBS Live, and I was sort of so caught up in Tuesday's CPI number that I just wasn't when at 8:30 when we sort of ticked down in yield up in price. It was like, well, there's no data here at 8:30. Not sure of the reaction. Well, there was data, PPI. For some reason, it wasn't on any calendar. Don't know really what happened. Just sort of didn't cross my mind that yesterday was PPI, given the fact that once CPI comes out, it's somewhat anticlimactic. That being said, this was a bad enough number or a good enough number, depending on how you look at it, that it mattered. So before we get into today, which includes quite a bit of data. Let's talk about yesterday's PPI, the monthly. And this was like, double your pleasure here. Last month printed at 1.1. It was revised to 0.6. We expected flat, and it came in at negative 0.3. So sort of in the world of looking at data that revises, right? On a 2-month, we were expecting 1.1. 1.1 last month, 0 this month. That's sort of what the market's expecting, right? We missed by 0.8. So the 1.1 came in at 0.3 on a 2-month. So on a 2-month, 1.5, that's sub 2% headline PPI inflation. Now, that's not the Fed mandate, but directionally, on a 2-month, that is a really bond-friendly print, right? The annual last month, headline annual printed at 6.5, revised to 6, expected 6.2, came in at 5.5. So again, that was a 2-month 1.2 miss, right? Huge. New York Fed beat core PPI on the annual. Last month printed at 4.9. We was revised to 4.6. We expected 5.2, came in at 4.7. So again, about a 0.8 core headline miss. Now listen, still printing a number of 4.7 on an annualized basis is meaningful, right? Here's what takes the edge off that. And I got to tell you, again, now this is not CPI, this is not PCE, but nonetheless, last month, May, printed at, in talking about this, I'm talking prior to yesterday, obviously. Last month, printed at 0.4, came in at 0.1, right? June, expected 0.4, came in at 0.2. So we had, again, a 0.5 2-month miss. That's an average of 0.25, right? But on a 2-month, if you take a 0.1 and a 0.2, we're at a 0.15 annualized out. Would that be what 1.6? I think a 1.6% core PPI. So, hey Bob, for 2 days worth of inflation, CPI and PPI, you just simply couldn't print better numbers. Full stop. You have on a 2-month run rate, annualized out. So it's not just 1 month at this point. On a 2-month run rate, you have about 1.2% core PPI annualized, CPI annualized. And on a core basis, you have about a 1.6% PPI annualized. Now, to whatever extent this flare up in the Middle East continues, one would expect that July's inflation data won't be as friendly. And this is where I say, if I was an advisor in the White House and understanding what President Trump's motivation is around interest rates, I'd really push that we get back to the table, because I think your ability to print 3 straight months of really, really encouraging inflation data would go a long way to moving the needle to the Fed I don't know about becoming dovish, but certainly backing off being hawkish. So 8:30 data, first move worse. Let's see where we are. Philly Fed prices came in at 53.9, slightly above last month. Claims came in at 208, missed expectations, revised up slightly. Net bad for bonds. Continuing claims revised up but missed. Net call it neutral. Philly Fed business index, huge beat. Retail sales on the screws, but down significantly month over month, 0.9 down to 0.2. But on the screws. And the so-called control group came in on the screws at 0.5. So a little bit of a hot number. Last month, control group was revised up. Market, not a huge reaction by any stretch, but market not loving it. 10s at 458. And we're up about 3 basis points across the board. MBS, anywhere from flat to maybe 6, 8, 10 ticks worse, sort of down in coupon. 4.5s, rapidly approaching support. Frustrating, right? From the standpoint of, you'd like some sort of continuation. We've been pretty choppy. Rally, pullback, rally, and we're looking like potentially a pullback here. We've got some home sales later in the day, a little bit of Fed speak, and then tomorrow, Ginny roll and stuff that, I guess sentiment at 10, is a mover. Let's talk about overnight here for a second. Again, continuing to go in this direction. I would say net, slightly bond friendly. Consumer prices in Italy printed flat on a monthly basis. Yearly was on the screws. Normalized actually missed, came in flat versus 0.1. And the yearly, also missed by 0.1. So, I don't know where I would put that. Maybe a C data point, B minus, C plus, insofar as we're concerned, but meaningful. Other than that, the rest of the data on balance probably neutral. Where we are in the markets, so overnight, Asia mixed. Nikkei got hit, I'll say that. Europe also mixed-ish, probably worse on balance, indicating mixed here. Dow up slightly, but all the other futures are off. NASDAQ futures almost off a point. VIX up about 3.5%. Commodities, we are looking to open crude at an 80 handle. Don't love that. 80 and change. Brent 85 and change. Gold down, silver down. Dollar stronger versus most currency. Bitcoin down a little bit. So yesterday, solid lock day. Still not where I would expect it to be relative to pipeline. I don't know if there's some borrower pushback. I don't know if originators are sort of taking on some undue risk, but nonetheless, give you an idea. We went short 5.5 coupon yesterday afternoon. 5.5s were printing at pretty solid numbers, and to me, it made sense to take some of that profit. Not 100% sure where we struck, but round numbers. If we struck around where I think we struck, we're probably up 10, 11 ticks on that position. 6.5. So here's something to keep an eye on, right? 6.5 showing some resilience. They've been languishing a bit. Something that's interesting in how this may or may not how this may or may not affect rate sheets, right? And some folks have been talking about this. There are times, and this is what makes it difficult for folks that do what I do, for example. And what's been really problematic, for lack of a better word, over the last 10, 15 years, but really in earnest since COVID is, we're noticing, like two different phenomena, for lack of a better word. One is the gap between bid and ask. Okay. So when an originator locks a rate, we're going to take a hedge based on a certain percentage. And that percentage is just generally tied to pull through. And then depending on how you hedge it, there might be some other percentages based on duration. But that's when I think folks get a little bit too fancy. I pretty much try to slot it where it should be slotted. But anyway, so now you're looking at, let's just say, potentially a 6-7 tick gap in the bid-ask spread, right? If you're marking to X, but you're putting the coverage on at Y, or if that loan falls out, you're taking that coverage off at Z, there's shrinkage in your P&L model that historically didn't exist. I mean, there's times where there's a half a tick spread between the bid to ask. To contemplate 10 ticks, is outrageous, right? Well, further, when you add to some of that risk, and this is not unique to right now, if you go back to, call it Q4 2002-ish, when we started looking at 7.5 coupon, dare I even say some cases maybe even an 8 coupon. Nobody wanted those TBAs. It was really, really hard to hedge that production. And so what you would find from time to time, and 6.5s are an example of this right now, trading pools outright yields, potentially better execution. So how does that translate to a rate sheet? What do you do on the desk? And if you're trading pools outright, that either means A, you're not hedged, or B, you're hedged down in coupon, which brings another level of risk unto itself into this scenario. So long story short, and some of that may or may not make a heck of a lot of sense, but just to provide some backstory to why I'm about to say what I'm going to say is, given potentially some resilience in 6.5s right now, what I'm going to really be keeping my eye on is, if you remember, we were saying 6.5s were sort of unreasonably disproportionately strong 30 days ago, let's call it. Now we've been talking about 6s being disproportionately strong. It's early to make this call, but are we potentially rotating back into 6.5s? It remains to be seen. So how do we handle today's action? 10's just below 4.6 at 4.59. We're kind of extending these losses, and I'm just going to say, the old rinse and repeat. You probably should have locked yesterday, and if you didn't lock, now you're faced with a tougher decision. Listen, notwithstanding this morning's data, you have to be incredibly encouraged by this inflation data. And, I'll say the same thing that I said yesterday. You're betting more on the end of the conflict or getting back to the table than you are the data right this moment. I don't know that that's a terrible bet. I am basically full on lock 6.25 to 6.75. I think it's a little bit of a coin flip. 6 7/8, 6.75 and above. You're probably running out of time on a July closing, so you may need to capitulate and just lock in on that. And 5.75, 6 1/8 and below, you're kind of back to a level where purely on a chart basis, it's harder to make a case to want to lock. You missed that opportunity yesterday that I'm talking about, how we took advantage of those, of how 5 5.5 coupon was trading. So next week, this calendar's not right. It's It is super early. Let me see if on Yahoo, if you have any questions, post them real quick. I just want to give a quick look at the week ahead, see if I can get my hands on a calendar that might be somewhat reliable. Monday, not seeing anything. I don't know what's going on with these calendars. Yeah, it looks like Tuesday, at least according to both of these calendars, Monday is going to be a slow day here on shore. Tuesday as well. Got to imagine come Wednesday, Thursday. I'm wondering if that's GDP. Our calendars have not. It's too early to talk about the week ahead for some unknown reason. Got to imagine if I just know the monthly cadence, although I guess Thursday the 30th, the 30th might be GDP. So next week, maybe there's some risk, maybe there's not. I'll try to dig in and we can talk about it tomorrow. So thanks for joining live, watching on replay. Until tomorrow, Bulls and Bears make money, pigs get slaughtered. Have a great day.